Ashi Anand joins us now. Let's take our conversation forward, understand what he makes of the current market setup, where is value in the market, and how is he investing. Ashi, great to have you in ET now. Thank you for joining us. Let's understand and let's start with the market construct. What is your view and where do you think we are headed in the near term?
Thanks a lot for having me. So just in terms of the market construct, I think largely in line to what you guys have been discussing on the channel. What we have had is a fairly strong move that we've seen over the last few months. Right now, this has happened on the back of interest rates kind of peaking, inflation peaking. And that was a clear headwind for the market, which got removed. And you saw the big move happening off that. Now, with this move, valuations are no longer necessarily cheap. And especially if you're looking at the core large caps, right? You still have certain clear headwinds for kind of growth. The global economic environment is clearly one headwind. Consumption is still slightly kind of weak. And inflation and interest rates, while having peaked, aren't yet reducing. So given that kind of construct, it doesn't really lay the foundation for a very strong bull market until some of these headwinds don't go away. But that said, what we are very clearly seeing is India is starting to look extremely attractive from a longer term perspective relative to all other major global markets. So you're seeing this in terms of the interest that you're seeing from FI flows, I think over $15 billion so far this year. You're clearly seeing India becoming more attractive as compared to China has a number of issues, right? So it's becoming very difficult for people to allocate money to China. Europe is relatively weak. The economic outlook out there is quite low. So India is in this context benefiting a lot, and this should also help prevent the markets from falling too much. So I think at least when you're looking at the larger cap indices, you're probably going to be in an extended period of a bit of a range-bound move until you don't see either growth starting to kind of come back and clearer signs of growth coming back, or there's no kind of major negative kind of event that could happen that could force a larger correction. And I think the one thing that we are watching out from that perspective in terms of a potential negative news flow is in terms of some of the developments that we're seeing happening in China, especially on the real estate side.
I wanted to pick up on the point that we were chatting about when you were last on ET Now. Your PMS strategy, wherein you have invested exclusively in some of the platform companies. Now, most of these stocks, barring a few like Nykaa, etc., have already doubled from their previous lows, right? Do you think a large part of the rally is behind us, or do you still find these stocks worthy for long-term investments?
Aisha, so we're actually extremely positive about this space. The way we look at it is it's a quasi-private equity strategy that we've launched. Our timing ended up being very good. We launched it pretty much close to the bottom. But if you're effectively just looking at what makes us so confident of long-term value creation in digital platforms, market capitalization growth is always driven by business growth. These are the fastest growing businesses by far. So if you're looking at a kind of digital platform strategy, we have investments in companies like Paytm, Nykaa, Zomato, Policybazaar, etc. These are the fastest growing financing companies, fastest growing food delivery, fastest growing shopping spaces. So growth is something which I think is very clearly understood, and there's very clear value migration happening towards this particular part of the segment. We built long-term models, and if you just look at the penetration rates in India, look at certain underlying dynamics in terms of the foundations for longer-term growth, the ability for these companies to continue to compound revenues at over 25% from a longer-term perspective is very clearly there. The misunderstanding, according to us, in terms of the listed market space is with relation to the longer-term profitability of these companies. What people don't necessarily understand is the sheer quantum of current expenses that are really just short-term in nature. As in, these expenses are primarily linked to the current hyper-growth phases that these companies are on. There are 4 distinct phases of the evolution of a digital platform. When you're in stage 1 and stage 2, you're trying to change consumer behavior. And there are very large amount of expenses to drive this change of behavior. As consumer behavior gets changed, and you're starting to see this, you can actually ramp down these costs quite significantly. And someone like a Zomato introducing delivery fees, if you're seeing someone like Paytm earlier used to have cashbacks, there you no longer get those. A lot of the costs that were involved in trying to ensure that consumers participate on a platform, those can be rolled down quite significantly. And also various monetization levers can be, there are various new forms of monetization that come up. Now, this can lead to very healthy profitability over the longer term. And according to us, a combination of much above industry growth along with a shift towards profitability should lead to very attractive value creation over
Right.
the coming.
Sure. Ashi, hang in there. Lots more to talk about with you, but we will slip into a very quick break with news that we're still pretty quiet in the index and it's the broader market once again, which is extremely lively. I want to get in your views here. What is it that you're making of some of these companies which are in a transformation stage, if I can call it that? Prime example being a Bharat Forge. Ashi?
Sorry, hey, yeah, I didn't realize you'd asked me the question. I think the one thing which is very interesting when you're looking at a lot of these auto anchs and companies such as Bharat Forge in the transformation phase is defense is clearly a very, very interesting opportunity for these companies. What you are looking at is India has the largest import bill of defense equipment in the world. I don't know if a lot of people know this, but we're actually larger than the top 2 or 3 other countries combined. There is a very strong strategic need to indigenize defense because a lot of our defense was Russia dependent. And as Russia is going through various troubles, you need to kind of de-risk from that from a strategic perspective. You're also having issues around geopolitics with what's happening with Pakistan, Afghanistan, China also becoming a lot more aggressive. So you're in a need to increase defense spends and you also need to de-risk. And therefore, you're seeing a lot of traction in the Make in India program. Now, this is very beneficial for both PSU kind of defense peers as well as companies such as Bharat Forge, etc., which are starting to build out their defense practices. I think for Bharat Forge, this is also particularly important given the fact that they do get a reasonable part of the business is still dependent on internal combustion engine kind of lines of business. And that is something which is at risk as EVs increase. So they do need to kind of find new lines of business. And I think defense becomes very attractive from them from that perspective.
What is your view then on these richly priced defense stocks? When I say richly priced defense stocks, Mazgao, Kochi, HAL, suddenly they're commanding P multiples which are even north of ABB, Siemens and Thermax.
So it's actually quite difficult. Honestly, it becomes very justified to justify those kind of valuations. But what becomes a little difficult is in terms of how lumpy these businesses are. So HAL, for example, the Tejas program is extremely important. Now, if they get incremental large orders on Tejas, you can actually see a very sharp, sustained up move in revenues. And from a longer term perspective, you could potentially start justifying some of those multiples. But on the flip side, any kind of weakness happening on the Tejas platform and the whole story could really go for a toss. Some of the shipyards are very dependent on specific kind of orders, and some of these orders are so large that if you get it, you can really justify some of these multiples because it can lead to a ramp up of revenues and margins, which kind of do justify it. Now, what's happening is in terms of the current valuations, you're really factoring in all of the positives and assuming everything plays out ideally, and you really aren't justifying any of the risk, which is why we at least are staying away from these pure play defense contractors, which have larger lumpy businesses. I think the only stock we have in our portfolio is Bharat Electronic. Out there, it's the orders are much kind of smaller and it's a lot more diversified. But these pure play defense PSU companies, it's a bit of a 0-1 in terms of how some of these orders play out.
Sure. Ashi, great to have you on ET Now once again. Thanks as always for dropping by.
Thank you so much. It's a pleasure.
Okay, that's the word coming in from the House of Valcreate Investment Managers.